My third or fourth time starting this recording. In this video, I'm going to be talking about knowing when not to trade. Okay. In various ways. You could say know when not to trade when psychologically you're not all there, you don't feel up for it, you're not 100% concentrated, you've not done you're rushing, you're not done your pre-routine tasks. But I'm talking about today, know when not to trade when price action tells you not to trade. So if we look at this piece of price here, see how I've got marked up as market maker sell model, original consolidation. In a market maker model, we will not always sweep the external terminus liquidity, being if it's sell side or being if it's buy side. This will depend on if you're following the higher time frame trend, if it's a short-term pullback, a couple different things. But just being aware of the market maker model not always being completed before a reversal happens. Being aware of that, okay, and being aware of where we are in price compared to the higher time frame and things like that. So higher time frame, we were actually bullish on the euro. As you can see, we've had the strongest stage that's been offset most recently is this previous month's low, I think it was, and break structure, right? So we are bullish on the euro, and we're bullish till buy side liquidity or the premium of the range, which is what we just traded into now, above 50% from here to here, right? So if you are one of those people that do get sucked into trading both sides of the market, this will be useful for you guys because, as you can see, the trade model shows itself. Original consolidation, smart money reversal, a H4 open, a high 10 o'clock. This follows my new H4 candle counting plan. Break market structure on a 50-minute here, break market structure on a 5-minute here. And I said to myself that if we reach here, this fair value gap, without retracing to here, I'm not going to take this retracement here because it didn't look strong enough. I'm not a reversal trader. This target looked a bit too far. We was definitely bullish already. DXY did look bullish as well, or bearish, sorry, if I remember correctly. Yeah, we looked like we was here. So yeah, always. So when you see the original model showing, this is the model, this is a correct trade, but it's just understanding the higher time frame bias being bullish, because once we fill in here, this price leg balanced, then the price can turn around. So always being aware of the fair value gaps in price. We don't want to break structure and fill a fair value gap. We want to break structure, retrace, to then trade to the fair value gap rather than trade after the fair value gap's been hit. Another example, I think I've got another one, maybe on some other trade that I talk. Same thing here, ran liquidity, broke market structure. You don't want to be taking this sell because this sell never goes below this low, right? Even though it doesn't go below the low, and it's the wrong time and everything like that. Just being aware of when if we break structure to fill in, we don't want to be taking the trade unless we like here we broke structure. So here we did the same thing, but why we could take this trade after filling in this imbalance is because high time frame is bullish, so it's stronger. We look for bearish PDWs to be ran, and because we broke structure again at the open of the day. Well, the open of the day is there in this new day, because this was Wednesday, this is Thursday. We broke structure of here, so that to us is a break of structure if we are bias high, if our bias is bullish high time frame. So yeah, just knowing when counter trading to look out for fair value gaps all the time, and know not to take, like here, same thing, pinched, break market structure on a 15-minute chart. Yeah, we can sell, but we're selling to the fair value gap, and then we have a retracement here to this area, and look, it gets ran. High time frame is bullish. We already filled in the fair value gap, so price can move. That's all for this video.